Good morning. I'm tracking the Charlotte commercial real estate market as we approach the latter half of August 2026. The Queen City sits at a critical inflection point. Banking headquarters, logistics corridors, and mixed-use development pipelines are all responding to a macro environment defined by persistent inflation and measured Fed policy. Today, we're breaking down what the numbers tell us about opportunity and risk in Charlotte's market right now. Let's set the macro stage. The 30-year mortgage rate stands at 6.82%, elevated, but no longer accelerating. The Federal Reserve's funds rate is holding at 5.33%. That's a stance built on conviction. Inflation remains sticky at 3.4% year-over-year. Those three data points tell us that lenders are still pricing in duration risk, and borrowing costs for commercial projects remain substantively higher than we saw 5 years ago. The unemployment rate sits at 3.7%. That's tight labor availability. For Charlotte specifically, that tightness translates into wage pressure across hospitality, logistics, and back-office sectors. Now, those macro inputs flow directly into Charlotte's fundamentals. A 3.7% unemployment rate means talent retention is real. It means Class A office space in Uptown can still command premium rents, because employers know that relocating skilled workers is costly. A 6.82% mortgage rate eliminates the marginal deal. Projects that penciled out at 4.5% don't work anymore. That culls inventory and sharpens competition for genuinely accretive assets. The 1,380 housing starts tell us something important. Charlotte's residential-to-commercial ratio is in flux. More housing stock usually signals metropolitan growth confidence. Where is Charlotte headed from here? 3 trends matter most. First, flight to quality is intensifying. Class A assets with diversified tenant bases and long-term lease structures are trading at lower cap rates than secondary stock. The friction is real. Secondary assets are still recovering from 2024 repricing. That creates opportunity for disciplined capital, but only for sponsors with genuine operational expertise. Second, logistics and industrial sectors remain the growth engine. Charlotte's geographic position, midway between major East Coast metros, makes it a distribution hub. Companies are still building inventory networks after pandemic-era supply chain volatility. Charlotte's market today rewards clarity and patience. Inflation is moderating, but slowly. Interest rates will likely persist in this band through year-end. That creates constraints, but constraints also create selectivity. For real estate sponsors, that means focusing on essential use assets, near-term lease maturities with pricing power, and tenants with actual growth trajectories. For investors, it means resisting the urge to chase returns in secondary markets. Premium assets at realistic prices will still outperform. Visit us at RipplEffekt.com for the full intelligence brief.